one thing I do like, and I just want to cover perhaps, because when we find the correct market to trade and we believe we're at the beginning of a market trend, or the beginning of perhaps an upwards push, that's obviously your first trade. As price comes back to the 20 moving average, we pick up a second opportunity to take a core setup. Now, we now need to think about risk to reward. We now need to think about risk management and how to maximize our position and maximize our reward. So let's imagine I'm risking 1% on my first trade. It goes up, back down to the 20 moving average. I'm now in a position where my first trade, my stop loss that was risking 1%, can now be brought to my entry point. So if your stop loss is now at your entry point, you have no risk on the table. By the time I go up, down, I could be in plus 1% profit here. If I'm at 1% profit and I'm already looking to take a trade in the opposite, to continue trading the same direction and looking to take an opportunity, I can now use my 1% gain from the first trade that's running live as my risk here. So I'm now risking 1%, but I'm up 1% from my first trade. So if my first one wins, my second one loses, I bank 0. But as you can see here, this trade's materialized. So now your first trade might be plus 2% and your second trade might be plus 1%, which means we have 3% capital growth running live over the basis of 2 trades that have met the rules. This is what we call scaling in. Now imagine if you got one more bounce. Your first trade would be 5% up, your second trade would be 3% up, and you'd be taking an additional percent on the last cycle, in trend. So that's how, if you select the correct time frame, you select the correct asset to trade, over 3 trades, you could get to 10% profit pretty quickly. And we use our risk, we use the profit on our previous trades as risk for any future trades.